You're tuned into The Air We Breathe, a conversation on how we can fight climate change and sustain a cleaner environment with Bennie Lee Williams and Lori Collins right here on Watch Lotus X.
uh, all the scientists say that there's a difference between weather and climate.
Okay.
So
Yes.
weather is short term, short term variations and fluctuations. Uh, that's very short term. Climate is much longer term trends. So when you look at long term trends, the the Earth is getting hotter, but part of climate change is it causes things to be more extreme.
Hmm.
So much hotter, and then it'll cool off, but it's never been this hot before, or much colder, or the storms are just more intense. So it
Right.
just creates sort of an extremes. But anyway, that's one of the things I learned in my program:
Hmm.
weather versus climate. Sort of short term versus the longer term trends.
Right, and it's easily you can mistake those easily just by not knowing, or like you said, the extremes as well, because we do think of global warming. Okay, it's when things get really hot. However, it can be the opposite, like we're feeling right now.
Yeah, it could be that things are getting really cold.
Yeah.
But anyway, I know we have a topic for today, but
Yes.
there's a lot of indications that the long term trends are getting warmer, and you see the glaciers breaking off in the Antarctic and permafrost melting, and some of those big fundamental changes. Anyway, that's a whole other topic.
It is. It is. Well, I actually, you know what? So this is what I want to. I want to slide into our topic with investor readiness, and when it comes to this right here, what areas? What, because this is somebody that just would not know. What areas would investors? What are some things investors look for so that they can kind of help with the combat towards
Yeah.
climate change?
So this is a big topic, and you probably know from my LinkedIn. Yes, really interested in.
Yes.
I love looking at the trends and what investors are, how they're managing climate risk, because
Okay.
I feel like that is the true free market solution. So, that's where the rubber meets the road. If
Right.
somebody's going to invest in your company or not, they're not being political or ideological. They're just trying to make money or not
Right.
lose money. So I'm going to kind of take a step back and talk about this in a way that I like to think about it. That's sort
Okay.
of organize the approach, because there's a lot here. So with investors, there's two big buckets that they're trying to manage. One is they're trying to manage the risk in their portfolios. They don't, if they've got investments in companies that are going to be hit really hard by climate change, they want to manage that risk. They don't want to
Right.
lose money. And then the other side of it is, how can we make money on this? This is a big, change across the world. There's got to be some way to take advantage of it and make money.
Right.
So I thought, let me talk about the risk part first, and then we switch to the opportunity part.
Okay.
Okay, so with climate risk, even within that, there's two like kind of big buckets. There's physical risk,
Hmm.
and that's like kind of acute things like storms, wildfires, just
Right.
big events that happen maybe less frequently, but really high impact. And then there's chronic risk, and that like the temperature gradually going up. Things are getting hotter. There's more droughts. There's sea level rise, which is really gradual. But those are some of the risk.
Okay.
Um, and those are all physical risk. And then there's another bucket called transition risk.
Hmm.
And that is things like legal and regulatory, or changes in consumer preferences. People don't need as many wool coats because it's just milder climates, or
Hmm.
um, there could be just different products. So those are called transition risk. They're
Okay.
harder. They're harder to because how do you measure consumer preference? So investors tend to be focused more on the physical climate risk, at least for now, because that's very measurable. So if you're investing in a company, let's take Diageo, the big, it's a big liquor company. So they really need a lot of water, and they have manufacturing plants in the world. So there's starting to be more companies that can look at a whole portfolio. What are you invested in?
Huh.
Procter and Gamble. What kind of companies are you invested in?
Right.
Your mutual funds or that you're individually investing in, and there are companies now that can see where you have operations.
Huh.
So they can look at, they look through all your corporate, and they identify everywhere you have an office or a manufacturing plant, and then
Right.
they can overlay. Well, if you're in Indonesia or if you're in Jakarta, Jakarta, the whole city is like sinking into the ocean. Then, and you've got a big manufacturing plant there. Well, that's a risk.
Right.
Or if you've got a lot of real estate somewhere that is at a high risk for storms, sea level rise, flooding. As an investor, I'm like, okay, I'm just going to note that's a risk.
Right.
So something I think is exciting and really well known is that these climate data companies are starting to get a lot of traction. They've got a lot of information. There's one called 427
Okay.
that has information on 2,000 companies and millions of actual facilities all over the world.
Okay.
So they can pinpoint, is your company higher risk? So this is like a whole new business that
This is
is
this
cropping
is
up.
exciting right here to learn.
Yeah, I think it's fascinating, and
It is.
nobody's really tracking it. So
No.
the woman who started, it's actually a woman entrepreneur, started
Nice.
427. Yeah, she started. I met her about 4 years ago, and anyway, she's French, and France is
Okay.
on the forefront. They made it a law that you had to disclose your climate risk. It's like a law in France. So companies were like,
Wow.
we don't know how to do this. So
Right.
Emily was able to start this company because she had a ready market with companies that were doing business in France that were saying, hey, we've got to comply with this law. We don't know where to start. So that was about 4 years ago. And now her company has been acquired by Moody's. I'm not sure if you're familiar with Moody's, but that's one of the top credit rating agencies in the nation. They
Yes.
bought her company, or
Wow.
they took a controlling interest in it. So I think it's interesting because it says a lot of validation. A company as big as Moody's is taking this seriously,
Yes.
and they're starting to try to figure out how to incorporate it into their bond ratings, for example.
Mm.
So they're saying, look, we're not going to hold it against you if you want to have these high risk properties,
Right.
but we might just make your cost of capital a little higher because we're going to start treating you as a higher risk investment. So it's going to
Yes.
impact the pricing for your bond issuances. And I think that is so powerful. S&P, the other big rating agency, they
Yeah.
also have a partnership with a company called True Cost that has a lot of
Huh.
data. And there's a lot of these companies cropping up that are starting to specialize in climate data. There's another one called Jupiter. There's one in North Carolina that's based. Well, it was founded in Asheville. I think they've moved to
Okay.
Triangle now. It's called the Climate Service. They are raising money. They are getting traction. And interestingly, I know we're talking about investors, but
Right.
the Climate Service just got a partnership with Aon, which is a huge company. So the insurance companies are also saying, in a way, an insurance company is an investor, and they're trying to manage their risk, of course, and they just did a partnership with the Climate Service to get this data to say where's the risk, which
Mm.
companies, how do we manage this risk, and at some point once these companies figure it out, they're still testing it right now. They're trying to use these models and use this data and test how
Hmm.
does this data really correlate with risk in our bonds or with risk in
Right.
our insurance, investments. And I think it's really powerful
It's
because
definitely.
eventually they'll say, look, if you want to get insurance from Aon, you have to do these 5 things to make you more insurable.
Mm.
For example, this is a great analogy I heard several years ago. You think about, we used to have a lot of problems with urban fires. You know, you hear about the Great Fire of Chicago, the Great
Yeah.
Fire of San Francisco. Well, now that doesn't happen anymore, right? You don't hear about
Right.
huge fires in downtown areas wiping out whole blocks. And it's because there was a mix of innovation. Somebody came up with the idea of a fire alarm system. Somebody came up with the idea of a sprinkler system. So
Right.
the entrepreneurs came up with these solutions. And then the insurance companies said, we're not issuing you insurance until you prove to us you have an alarm system, a sprinkler
Yeah.
system. So the insurance companies drove adoption of this new technology. You know, just pure, they were trying to be do-gooders. They're trying to protect their own investments. And then also some things happen on the government side with building codes and that kind of thing. But all this
Right.
together, that risk has been managed. You don't worry about being in a building downtown or on the 30th floor. You're not worried about the fire risk. There's all kinds of protections.
Right.
So take that idea to climate. As the insurance companies and the investors start looking at, hey, I need you to make these changes, it's going to make they're not looking to dump their investments. They're looking to fortify their investments. They
Mhm.
want them to be stronger.
Mhm.
And they can help drive a lot of changes to get the companies to take actions to be more resilient or maybe invest in more renewable energy, make some changes. Um, so I think it's a really positive and exciting trend. So there's a lot of pressure from the investors to say, look, we want you to at least disclose your climate risk.
Right.
You know, we've got 200 companies, you know, that we're invested in. We want you to at least identify and disclose what those risks are. And it's not required by law, but there's
Mhm.
this pressure. So the major investors like BlackRock is one of the largest and, you know, overall investors in the country.
Right.
They're starting to tell their companies, for us to invest in you, we want you to identify your climate risk.
Hmm.
And we'll work with you, but at some point, we're going to push to have different management. If we
Okay.
don't see any progress on this, as a large investor, we're going to start putting a little pressure on the management or the board and press to get different board members if we don't see some progress on this. So that's super powerful.
Very.
And you know, Vanguard, you know, major mutual fund company,
Right.
that they are also saying this. State Street's another big investor. And
Is
again, it's not punitive. They're trying to protect their investments.
right.
And if all their investors or all the companies in their portfolios start improving their resilience and ability to manage climate change, it's good for everyone.
Right.
Everyone wins. So it's very, very powerful.
I see this being powerful on so many levels. One of the levels I was thinking when you were speaking is that this is going to push, like you just ended with, everyone wants to kind of improve the climate because you want to basically improve your status to be invested, or just improve your status of how you look, period. Uh
Yeah, I mean, it really comes down to, you know, just looking out for yourself. If you're going to
right.
invest in something, you want to take care of it. You know, you've put your money, whatever it is, you know, you've invested in your home. You want to take care of it, but
Right.
not just out of, yes, to just feel proud of your house, but when you get ready to sell it, it's going to be more valuable if you've taken
Mm,
care of it along the way versus if you just, you know, let it go to ruin. So it's the same thing with the investors, and I love it because it doesn't require politics. It
right.
doesn't require legislation. It doesn't require any policy. It's a complete free market solution.
Hmm.
And there have been some interest in the U.S. Congress for passing legislation that it's required disclosure in your securities exchange filings, but it hasn't gotten a lot of traction. So it could become law, but I think there's a lot of potential for this climate risk disclosure just to be sort of through force of pressure from the
Right.
investors. And, you know, I think
Does it? do you see it being a thing of where who you have your climate risk uh kind of like not monitor, but it's almost like a just kind of like audited in a sense, or kind of like just is there, I guess my thing is there a thing of, okay, where you're getting your climate, who's looking at your climate, who's grading your climate risk, and how
Well,
investors look at, okay, you went to company A, but what's the history of company A? Is
yeah.
it going to be, that's where I can see politics kind of being played, not by government, but by companies or investors. Could that be tricky, or am I just
Um, I see. I think I understand where you're going, but I don't think that's. I don't think there would be a political aspect to that. Um, I mean, look, people are just trying to manage the risk, but it was just. It's only going to be one piece of it.
right?
So if you're, I don't know why I keep using Procter and Gamble as an example. I just feel like everybody
They're the major. Procter and
everybody
Gamble
knows
owns
Procter and
everything.
Gamble, and everybody uses their products. So it's
Yes,
just a sort of a household. Everybody can relate.
right.
Um, so if you're investing in Procter and Gamble, you're looking at all kinds of things. You're looking at all their different products, all the different um, sales trends on the products. You're looking at how they're doing against the competition. You're looking at their earnings. You're looking at their margins. You're looking at a lot of things. So their climate risk is just going to be one piece of it. So you could argue that it's not going to make or break the investment. Um, somebody's probably not going to, dump their Procter and Gamble stock over this issue.
No, but yeah, no.
Yeah, so I don't. I think it is just the steady pressure
Okay.
to, every year you go into meet with, the investors come in. They sit down with the CEO, and it's just on the list of questions. And after a while, the CEO, there to be this silence in the room when they get to the questions on, okay, well, let's talk about how are you managing your climate risk.
Mhm.
Silence. So it's just sort of a steady pressure, steady interest that, it's going to take a while, because the CEO is probably thinking, well, I know with big multinational companies, they feel like if one of our manufacturing plants gets wiped out by a storm, we're such a huge company, we're just going to shift operations to another manufacturer. I mean, they don't consider it a material risk. They feel like they have much bigger risk to their business
Mhm.
than climate, because they can just shift. So, that's one of the areas, like, how do you get them motivated? And part of it is the investors just continuing to ask, well, let's dig into this, and look at all the operations. And it's possible that companies could be rated over time, rated for their climate risk. Um, I think there's
Eh,
probably the technology to do that. It's Again, it's not going to be, for a lot of major Fortune 500 companies, it's not going to be make or break.
right.
But here's, did you have another question?
Oh no. Well, let me double check before you move on.
Okay.
I did have a question as far as while it won't make or break the major companies, do you think it's something, because obviously this is a question, I guess this is a thing of that investors may look for towards companies that deal with fuels, companies that deal with having waste and those things of that nature. Do you see it being a thing where investors
Well, um, yeah, there's a couple things that's sort of a different topic.
okay.
That if investors want to not be invested in any fossil fuel companies, that's kind of a different investment approach. That's what the exclusionary. Like, we're
Okay.
just going to take out all the oil companies. And what I'm talking about is called integrated. You just integrate it as part of your
I see.
investment process. And even with the fuel companies, I think there's a strong. I know there's some companies and some universities that are divesting, and that plays a role in pressuring. But there's also a strong sense that if you work with the companies, that the biggest win is to get them to look at how to diversify their business and diversify away from the oil, from so much fossil fuels, because I think in the grand scheme of things, investors are not trying to punish or, put out of business a major American company. There's not a win in that by putting someone out of business. The win is to just go to BP, a major oil company, and say, how can you diversify your bottom line? And BP is a great example because they're doing a lot to diversify. They have an arm called BP Ventures where they invest in clean energy and electric vehicle companies.
Right.
And then they also have a program called BP Launchpad where they're saying, we don't want to just invest, we want to make these companies part of BP. So they are contributing to a major part of our earnings over the next, 5, 10, 20 years. So that's just one example where, instead of vilifying an oil company, work with them to help them look at how to take the skills they have as a business and bring that to other sectors that are more clean. And it's good for the environment, but it's also good for business because if that's the way the market is moving, then you're not left behind.
Yes.
You're not going to become Kodak that couldn't figure out how to move on to digital.
Right.
And, so Kodak, they're still got their Kodak cameras and selling film, and they couldn't figure out how to adjust. Nobody wants to be Kodak. And so you want to figure out how to adjust. And I think that's a more positive way to go.
Okay. I like
that. The point I was going to go back to when we were talking about, how businesses, does it impact their rating or their attractiveness as an investment? Another trend that we see happening is in the municipal bond market. So if you think about, cities and states, the way they get their capital to, build new buildings and build roads, a lot of times is through issuing a municipal bond. So the Moody's, the S&P, they're the bond rating companies. So if a municipal company like a Moody's or an S&P, they're looking to rate the bonds for North Carolina, for example, and they see that, North Carolina, they get wiped out every year. Like, half the eastern part of the state gets wiped out by a hurricane. And over time, that damages the bond rating for North Carolina because, you lose a lot of property tax revenue. If entire parts of Wilmington, New Bern, all these areas get wiped out, that hurts their tax revenue, which is the revenue they use to repay their bonds. It also impacts their income tax revenue because all those businesses get wiped out. Right. And that's the revenue that back the bonds. So they may say, okay, all right, North Carolina, we know you're good for it. We'll issue you a bond, but your bond rating has been lowered, so your price on that bond is going to be higher. And so it basically says your cost of capital just went up because you're not managing these climate risks. And we, as the bond rating agency, we want to make sure our bond's going to be paid back. So that's where, to me, it's more a direct impact on your cost of capital is in the municipal bond market. Potentially. I mean, it hasn't really happened yet that we're aware of. It might be subtle, right. But you can see that as a direct cost. So it would actually be really helpful to start putting that kind of cost on it because it helps a state say, look, we're going to go spend money making these areas of our state more resilient. We're going to make them less prone to flooding, less prone to damage when there's hurricanes. We can't stop the hurricanes, but we can make our buildings more fortified to recover from them or not be wiped out. We're going to make our coastlines more resilient to sea level rise to protect our tourism industries. And it helps them justify those investments if they know this is what we're doing to protect our cost of capital because we want to keep a AAA bond rating. Yeah, that keeps our cost of capital low, to borrowing from the state. So that's where it actually ends up being a positive. The rating agencies are not being punitive to say we're gonna downgrade you. Right. They're actually leading them to help justify those investments. So I think that's a really exciting trend and possibility.
Wow. Wow.
Yeah.
That is exciting information on, well, one of the things that come into my head is just the new possibilities of now new jobs and new opportunities, new ways of just doing business. Anytime there's a new market open up, I'm like,
Right.
I'm like, wow.
Exactly. So I feel like, if investors, if businesses embrace this instead of pushing back and saying we don't believe in climate change, we're not dealing with this, the more that everyone embraces it, it's like, wow, there's a lot of opportunity here. And you asked me about where are some of the opportunities for investment, what types of businesses might investors be interested in. I came up with a huge list.
Oh, nice. Okay.
Yeah.
I'm gonna have to make
So
a note.
yeah. So one is this whole area I've been talking about, climate data. So there's businesses popping up that specialize in these huge databases, tracking everywhere, millions of facilities where you have an office or a manufacturing plant all over the world. They also are looking at real estate investments and REITs, the big real estate investment trust. So that's like a whole type of business that's new. So 427 is the one that was founded in California. They've already gotten a major investment from Moody's. There's another one called Jupiter. They've raised about $30 million in capital.
Oh, wow.
There's the one in that was founded in Asheville. I believe they moved to the Triangle, called the Climate Service.
Okay.
They are getting investments from several venture capitalists. Plus, they're getting clients, which is revenue. I mean, that's the best investment.
That is. Yes.
Yeah. So they're getting clients.
Wow.
So that is a really interesting area of business that's brand new. So that's one area for investment. Then things that are more common, any kind of renewable energy, solar companies, wind companies, hydro, geothermal, all the energy storage companies. Those are businesses that are attracting capital because they have a high growth potential. There's one actually that came to Charlotte for a while. It was a British company that had moved their headquarters to Charlotte temporarily, Zapco. And they were a type of battery company. They had lots of different batteries, some for electric vehicles, some for appliances, Zapco. And they got acquired and have now moved, I believe, to Texas. So they've moved out of the North Carolina area. But that's another example of a business, is a startup. They were in the Jules Accelerator program and they got acquired.
Wow.
So you see it happening. Then also anything around electric vehicles, charging stations for electric vehicles, indoor agriculture is becoming a big market because agriculture creates a lot of carbon emissions. It takes up a lot of space. There's fertilizer, so there's both toxic issues with agriculture and there's the climate and carbon emissions. So indoor agriculture. Another one of my favorites is plant-based meat products. So Beyond Meat is, they're a public company now. They're no longer a startup, but Beyond Meat, I've been tracking it. When the market was down in March, I nabbed some of their stock at $60.
Oh, wow.
Just invested in Beyond Meat, and I think today they're up to 145. So I think that's a company, in my opinion, who has a lot of potential and a lot of benefits to moving to plant-based meat. I've tasted a Beyond Burger. I thought it was great, and it gets a lot of emissions. I won't get too far down a rabbit trail with that, but that's another whole area for investment. There's another company called Impossible Foods that's just like Beyond Meat. They haven't gone public yet, but that's what to look out for when they go public. They should, they'll probably be.
Okay, I'm gonna write this down.
Yeah. So those are some areas for investment. There's a lot of accelerators popping up. The accelerator programs are like the one in Charlotte's called the Jules Accelerator. And they are identifying companies that have good ideas that they think have the most potential. And then they're working to connect them to clients or to connect them to investors. And you know, Jules has been around since about 2013. And the companies that have come through the Jules program, this is just one program in Charlotte. Those companies have already raised about 200 million in
Oh
capital.
wow. Wow.
So
And this
there's
is from 2013 to
it just got started in 2013.
wow.
I mean, just got set up. We didn't really have companies in the program until 2014 for Jules. So yeah, in 6 or 7 years, the companies and was only has maybe I don't know 6 times 3 programs per year, maybe between 12 and 18 companies a year come through the program. And of course, they don't all make it. A lot of them don't make it, but
Right.
the ones that do, are getting a lot. Well, Zapco is one that did really well. They were in the Jules program. Atom Power is a company that produces power electronics. They've done really well. They have a
Okay.
partnership with Siemens. They were started someone who was a graduate from UNC Charlotte. They had their office set up on the UNC
Wow.
Charlotte campus, and they've done really well. They've raised money, and they've had some really strong partnerships that generate revenue. So those are some areas of investment opportunity, and then another area that's starting to emerge is resilience. How do you invest in resilient infrastructure? And this has been maybe a little trickier because I think there's an assumption that the government should infrastructure. That's not for private investment.
Okay.
But we definitely see more, Bank of America, Toronto Dominion, another big bank, that are looking at how do they invest in infrastructure plays and looking at how to get a return on capital in these big infrastructure plays. It could be around water systems. In some cases, they're probably being paid like a municipal bond. They're probably being paid back on tax revenues if it's a municipal investment. There's growing market for green bonds, which is a type of bond where you're investing in some kind of green infrastructure. It could be parks, water systems, berms, whatever is needed to make a city more resilient. And there's also interesting green banks. So Connecticut has a green bank that's been successful. Maryland has a green bank, and that can be structured in a lot of different ways. That's a big topic, but the idea is there's more interest in attracting capital and deploying capital around resilience, which is how do you prepare yourself to either avoid the impacts of climate change or recover quickly. It's a little bit different from renewable energy. So there's a lot going on in this area. It's really exciting. It's not that well known.
It is not, because you're naming some things as I'm taking notes.
Well, I tell you what, it's also the big banks are really driving it. So
okay.
The big companies are the ones looking at this. When I've talked to smaller investment companies and said, well, what are you doing around investments? And they're like, oh, well, we have a corporate sustainability program. I'm like, that's not what I mean. I mean, making money,
right?
Like literally investing in this. And so it's not mainstream yet, but I think it's a big opportunity.
Not yet, but we're I love what you're saying. I love to be first on tip of the iceberg.
Right.
Man,
so it's a market driven
yes,
ways to protect your money and make money.
Yes.
By understanding the impacts of climate change.
Why not make money while also improving the air and climate in the world?
Exactly.
That's why I love what you do. You're making money while improving humanity.
Yes. There's a book, Green to Gold. Green.
I like that. I like that. I like that.
You can make some gold on your green investments.
Yes. So you said as always a good amount of information to dive into, to chop up. So I wrote some notes down here about the green banks, about resiliency. Definitely some notes in here that about the climate risk, and really going back to that, and physical risk and transition risk, the climate data companies, the municipal bond market. This was good. I like